One of the, obviously, the big sort of components of what we're doing here today and really over the last couple of days is this idea of how sustainable strategies have just become much more important. A couple of weeks ago, the global strategist over at Allianz, Neil Dwayne, he was talking a lot about this idea that how investors really need to sort of address these issues in a much more deeper and holistic way. And he really sort of drove home the point that if you're not addressing these issues, you're not aware of them, you're missing out. And you're going to miss out big. And I want to start on this general idea. And Lily, I mean, we could start with you on this idea of, because you have this title of Thematic. Thematic. Laura, you have the title of the. Well, there you go.
So, how do you talk about themes, though?
So let's start with Laura, because you have the title of Thematic Investing, yes, which I think is a great title. But it really gets to the idea here. When we talk about ESG, there is sort of a broader umbrella of what we're talking about, this idea of themes and narratives and how you sort of structure those themes and narratives for clients.
Sure. So I think it's an interesting way, the thematic angle is an interesting way to think about ESG and sustainable investing, because it really focuses on these larger world trends and secular forces that we see unfolding. So a great example is consumer preferences are changing. So we've seen increased interest in things like plant-based meats, nut-based milks, all of these things. Consumers want to be more conscious about what they eat, where the products that they buy are coming from, and this is going to have a real impact on companies' operations. So to your point about being left behind, if a company isn't thinking about these shifting preferences, changing regulation, they're going to be at a disadvantage in the future as these trends continue to unfold.
So Lily, as someone who doesn't have the title of Thematic Investment Manager here, can you just jump in and kind of expand on what she just talked about?
Sure. So, and look, you may have already heard this yesterday, but our industry is obviously a spectrum, as you're alluding to. It's this notion that you can either avoid stuff which might be sort of out of alignment with your or your client's unique impact objectives. You can lean into positively a set of themes or a broad range of criteria, which we in the industry obviously refer to as environmental, social, and governance criteria, which can hopefully help you to make a better investment decision, ultimately because you're seeking to invest in companies who are thinking holistically about their operational footprint, how they treat employees, how they utilize natural resources, and ultimately how they're governed, which can absolutely drive future performance potential and definitely mitigate risk. So these are kind of different aspects or tools, as I like to say, that our clients have at their disposal to be able to execute a fully diversified portfolio that ultimately can be across the entire spectrum, both public markets, private markets, equity, and fixed income. I think what's most interesting, though, is that clients are coming to this conversation in many different ways. Historically, there was a lot more discussion around what do I want to avoid, right? What are the industries or the geographies or the companies that are really out of alignment with my personal values, morals, or ethics? And today, the conversation is a lot more about what do I want to lean into positively? What are the themes? What are the issue areas that I want to support with my money in order to create the world that I want to see in the future?
So that's interesting, because when we talk about, if you're a potential client and you're talking about, where do I put my money? At the end of the day, the goal is still the same, right? If I put $1 down, I expect to get more than $1 somewhere down the road. But the idea of what constitutes wealth has sort of changed, I would think. And Farnoosh, I could pose this to you, sort of what is it now that constitutes wealth for a lot of folks out there? How has it changed?
Well, my audience is largely women and millennials, so I can speak on their behalf mostly. I mean, for the younger cohort, they're looking for flexibility and ability to work from wherever they want. They want to invest and shop where they feel in alignment with that brand, that retailer's values and objectives. They're not buying anything, they're renting everything. And I also know that millennials aren't really investing. And if they are, they're starting with their 401ks. So I think and women, we have our own sort of set of challenges, but also I think, we're living longer. We are better investors. Studies are showing, yay. And so there's a lot of positive factors, I think, influencing women. I think that for everybody that I just mentioned, I think the real underlying issue is awareness and education and transparency. This information, they're not necessarily going out to get it. They're not learning. They know that maybe the store down the street, or they read a headline and they discover that, a retailer did something that wasn't aligned with one of their values, so they're not going to shop there. But is that same stock in their portfolio? They may not know. And so we're seeing where they're putting their money where their mouth is when it comes to spending their dollars as consumers. But as investors, I think there's still a lot of opportunity there to educate them.
Laura, do you worry about the potential, though, that if a client says, well, I only want to sort of be invested in a certain space that has some sort of social dynamic or moral dynamic to it, that they could then potentially miss out on, more profits by just being a little bit more agnostic?
Absolutely. So, I mean, as a sustainable investor, you don't want to narrowly just focus in on one particular theme in my world or topic in terms of ESG criteria that you might be considering. And I would also add the point, though, that we have this idea that clients interested in sustainable or responsible investing must have some kind of values alignment goal or special interest in the environment or addressing inequality. But I think the industry has really moved past that at this point, where we have investors who simply want to make the best investment decisions they can. Because the environmental, social, and governance information that we now have at our disposal can be used by any type of investor. So even if you don't have a socially responsible motivation, this information can be a useful tool for investors across the board. And we see this especially in the institutional space. We did a survey of institutional investors, and the reasons they were pursuing sustainable investing included things like it's a risk not to. They think they'll have better performance. And those types of rationales actually outranked having a positive social or environmental impact. So I just want to make that point that even if you think sustainable or responsible investing isn't for you or for your client, there may be something there that could be of interest.
So go ahead, Lily.
I would just build on that a little bit. I think you can think about themes systemically and ultimately build a diversified and resilient portfolio that does tackle specific interest areas. And I do actually think we're seeing from our clients a lot of specific interest across different dimensions. Key leading themes are really climate, right, and gender and multicultural diversity, as well as faith-based investing. And if a client comes to you as an advisor and says, I'm really interested in transitioning to a low-carbon economy, not only in my lifestyle, but also in how I'm investing my assets, I ultimately think you can actually build a diversified, resilient portfolio that addresses that singular theme, because it's such a broad and systemic theme, and you can look at it at multiple levels and across all asset classes.
How are you doing that? Are you doing that from a bottom-up approach where you're just sort of looking at the finances and seeing which companies fit into that ESG criteria, or do you start at the top with that, whatever the ESG criteria is, and work your way down?
So remember, these are tools, and there's many different investment approaches that utilize the tools, right? If you're talking about an actively managed strategy that might leverage fundamental financial data, ultimately to build a buy list, that will incorporate not only how its financial statements are performing relative to peers in the sector, but also how it's performing in terms of the utilization of natural resources, right? How they're treating employees and how they're governed. So this additional pool of data is now at fundamental analysts' disposal, thanks to Bloomberg, thanks to many of the other ESG data providers. And ultimately, that's driving a smarter investment decision, as was said earlier. So that's an actively managed approach, right? There's also more passive or direct indexing approaches, which might look at something like revenue exposure to climate solutions and how are companies generating revenue across renewables, alternatives, energy efficiency, and other sources of climate resilience, and ultimately build a portfolio more from that angle. So it's a tool that can be leveraged across all of the traditional approaches that we already use in the investing world.
And so, Farnoosh, there's a lot that sort of goes into that basket, though, and it can get kind of confusing, at least from a client perspective. Do you think that the way things are now in the industry, that it's clear to people what they can pick and choose from?
No, I don't. To be candid, I think that people do feel overwhelmed. They do feel like they don't know where to turn, and it could just be that they're overwhelmed in their personal and professional lives. Investing, they really compartmentalize that. That's not, sort of part of the holistic. A lot of times, it's like, oh, I'll deal with that later. And as much as the 401k managers and HR and employers, insist upon and provide the education and provide the literature and do the workshops. I mean, I've been in this industry for long enough to know that it takes about, like any consumer, it takes like 7 to 8 touch points before you realize, oh my gosh, I have to actually buy this or invest in this or take action. And so here's an opportunity, right? I don't know what the silver bullet is, but I think that it's just a matter of positioning also these investments less as sort of like, here's a vehicle to help you retire. Because again, to your first question, the idea of retirement is not, what is that? It's evolving, and some people, if you ask them now, like, I don't think I will retire. So it's about how do we position the messaging around investing in general to have it become more relatable now to the younger generation that will need to grow their money in order to have money when they're older. So perhaps it's that we position it as, here's an opportunity to invest in vehicles that align with your values, just like you are shopping, just like you are making everyday decisions. Your portfolio is a reflection of who you are. And you got to make it online and extremely accessible. Phones, I mean, there's, I'm not a behavioral economist, but just getting people to save money, forget investing, is hard enough, right? So now they're getting text messages via apps that's saying, hey, nudge, maybe you should save $5 today. And so you do that because the app knows that left to our own volition, we won't. So we need as much of this sort of facilitation as possible. And I think increasingly for the younger generation, as they're overwhelmed with so much in their financial lives, student loan debt. I was just reading today that they spend about 55 to 60% of their income just on housing right now on average. So there's very little left to feel like they have the power and the capability to do something like investing, which for them, I think they really think of it as sort of this, oh, I'll get to that once I figure out all of my other responsibilities.
Is there enough, Laura, regulatory oversight of sort of what the criteria is or for responsible investing, ESG, and all of these products?
I mean, I would say there really isn't a one-size-fits-all approach that needs to follow specific regulations. One piece of guidance I would point to is the Sustainable Accounting Standards Board, so the SASB. For those accountants in the room, we all know the FASB very well, and they've started to provide guidance around which ESG, environmental, social, and governance characteristics, are most relevant to certain industries. And this, when we think about using this information to make better, more informed investment decisions, it's all about understanding which of these criteria are most material to the bottom line for certain companies. So I'll give you an example. If you're looking at a technology company, you might be most concerned with things like data security or employee turnover, whereas if you're looking at a transportation company, you may want to focus on things like emissions or employee safety. So that is at least one body that's helping to kind of provide a framework for investors in terms of how to start to use this information to make the most investment relevant decisions. But again, there are investors who are more motivated by a specific cause, as Lily mentioned. So in that case, you can certainly cater to focus on specific ESG information if that's something that a client is very interested in and that's their priority.
With the ESG standards we have out there now, though, have you seen a correlation, a positive correlation between those ESG standards and the financial performance of the companies themselves?
So I would say that it really depends on how the information is being used. So it's very difficult to draw an exact line from one ESG data point to financial performance. One data point we looked into a lot as part of our research is gender equality. So looking at gender balance in the board of directors and in senior leadership, and we did find a positive association there. Again, not a statistically significant correlation. It's very, very difficult to prove these types of relationships. But that being said, when ESG information is used by an active manager in the appropriate manner in terms of using that information to understand how these things might influence the bottom line, how it may influence the risk a company is facing, also looking at sustainability trends in terms of understanding how a company is positioned for these changing consumer preferences and changing regulation. All of these things can be additive to the risk and return balance. But it's very difficult, as I said, to say, this ESG factor correlates exactly to this level of output.
Sure.
Yeah.
So Lily, how do you measure then the I guess, the impact of a portfolio that's positioned in one of these sort of areas?
It's a great question. It's a question that we didn't have an answer for really until this past July. And I think the broader industry, frankly, has been struggling with this question as well. We've always had an answer to the question, how am I doing from a financial performance perspective? But this idea of how am I doing in terms of meeting my environmental and social goals has ultimately been unfortunately a gap in our ability as a financial services industry to provide that information to our clients. So we decided to respond to that question by building a proprietary technology application called Morgan Stanley Impact Quotient, Morgan Stanley IQ. And the idea is it's really an end-to-end solution for a client from the discovery process, what are the areas that you're interested in, to the analytics, how does my portfolio down to the security level perform on the basis of the environmental and social priorities I hold, and then where there's misalignment, how do I work with my financial advisor to continue to improve that alignment over time. So we've really taken a data-driven approach, ultimately seeking to align a client's custom set of impact objectives with their overall portfolio performance from the perspective of environmental and social outcomes, which is helping clients have insight into that question.
Is the notion that a client would give up some percentage point of return in the interest of being a little bit more socially conscious, is that still a valid argument to make?
No. So here's the deal, right? This misperception of performance is based in reality, right? In the early days, let's say 1970s, 1980s, the only product that we as an industry had available to us was restriction screening product, right? It was a broad market index or an actively managed strategy, which ultimately cut out certain companies, certain countries, or certain industries. And it didn't re-optimize the portfolio. It didn't think about factor overweights or underweights relative to an index. It just simply cut those securities out. Now today, we've really transitioned from that mentality, right? We have institutional quality investment tools that allow us to ultimately construct a portfolio that can mimic an index or can beat an index. In our research, which is slightly different, it sounds like, than yours at UBS, right? We see essentially no statistical significant difference in performance between traditional and sustainable investments. They perform in line over a 7-year period, which was our most recent analysis. But the zinger is that they do so with less risk, that we actually do see significant downside protection over that same 7-year period. And so remember, returns aren't just about financial returns, they're about that risk-adjusted return. How much risk am I taking to get the financial returns I'm seeking? And so that integrated equation, I think, is really important.
Well, just to layer onto that, which is such an interesting point, nothing that I knew, I think that there's an opportunity here for your team and marketing and communications to really pair up, because at the end of the day, this needs to get communicated right to the average consumer, the average investor, who, as I mentioned, is like really kind of all over the place, but really if you can cut to it and say, here's an like, did you know? And to really put it in at their kind of speed and appreciation level, I think huge opportunity, because, you know, I mean, I've been on panels or I've spoken at events in front of younger audiences, and people have said to me, like, there's a distrust, right, of financial institutions, or on one end of the spectrum, like, I'm a socialist, so I don't believe in capitalism. I mean, there are these beliefs out there.
But they still want to invest?
No, they want to know how they can grow their money without feeling icky about it, right? Without feeling like they're giving their money away to the big, you know, scary people. And I think that we just need to kind of take a step back and really, again, reframe and reposition the message, and with all the truth, that there is now data that is out there, so that they can feel better really about the moves that they are making with their money.
I would just make one point too on the, you know, looking at the ESG data, and just kind of emphasize that when you have an ESG product or an ESG index, it's just very important that clients understand exactly how that data is being incorporated. So for example, you could look at overall scores for a company and you could focus on those that score the best. Or you could say, I'm going to focus on those companies that score lower, but they're actually improving. So there's a lot of different ways that this information is being used, and that is what will drive whether that specific product will outperform. So I just think it's important to make sure that that's understood. And then another thing I would point out is that in terms of helping clients understand what they're getting, so if let's say you're invested in an ESG equity index, you might have oil and gas companies in there, right? Because if it's being managed in such a way that it's just looking at the overall ESG scores, the cleanest of the energy companies will be in that index. But if you want to combine a thematic approach with an ESG approach or use certain exclusions, it's just very important to make sure that clients look under the hood before.
Well, personalization is like
Yeah,
really
exactly.
the driver here, and people want to personalize everything now, and so could they do that with their stock picks, even more than they currently are able to, so literally going through prompts that's like, tell us about, it was opposed to just like, when do you want to retire and how risk averse are you? What are your values? How do you feel about these issues? And presenting as part of your portfolio an aspect that is aligned with what you're talking about.
But
I think
that kind
would
of
be great.
personalization, I mean, it takes a tremendous amount. We're not just constructing a 60-40 vanilla portfolio here. You mentioned the data aspect of it. I mean, is the data out there, is it reliable enough or comprehensive enough to do what Farnoosh is talking about?
I mean, you'd be surprised what you can do. We have a tool at UBS where we can take a client's equity portfolio and we use this tool to understand how the portfolio lines up across different E, S, and G characteristics. So you can see, well, my portfolio looks good from the E perspective, but not so good from the G. And also tell you exposures to certain controversies like weapons, gambling, alcohol, whatever it might be that the client wishes to avoid. So there are tools. They're not perfect, of course, in terms of, every data provider that you might look at may be coming up with these scores in different ways. So there could be some variation, but you would be surprised what we can do. And there are certainly ways to customize, I would say, at this point, for sure.
There's literally hundreds of ESG data providers, right? And some of them take a broad market approach and are looking at ESG data more holistically. Others dive very deep into a specific vertical, especially around carbon or gender diversity, right, or other thematic areas that are interesting and also market drivers. And you can combine that data, right? You don't have to look at a single source. You can combine that data to ultimately look at some of those correlations and seek to incorporate the data that can ultimately drive better investment decisions.
Let's talk quickly about demographics. I mean, Farnoosh, you kind of touched on it before. You spoke about some of the younger folks, but is this a trend among clients that is just sort of confined to the millennials or the Gen Zers? I mean, do we see older investors, people from my generation and the baby boomers, are they also sort of gravitating to this?
I don't have any data behind this, but I think my guess would be not as much. I mean, because their concerns are, they're getting closer to retirement, so they are more interested in returns, perhaps. And, to your point, it doesn't have to be either or. You can be socially, you can be a value-driven investor and also make returns. But I think that, when we talk about, values and these sorts of issues, I think we're talking more about millennials and we're talking more about even Gen X, who gets forgotten a lot. But I would say it's probably more relevant for the younger set.
I'm Gen X, I don't forget it at all.
No, yeah.
I have a little bit of different viewpoint
Yeah.
I would love to share. So we just actually did a survey on interest around sustainable investing across generations. So surprise, surprise, we did see the millennials' greatest interest. So 83% of those 18 to 35 said they were very interested. But then, if you look at 35 to 50, 63% said they were interested. 50 plus, 30% were interested. So those numbers are pretty good.
I think everyone's interested.
Yeah, they're interested.
Right.
But and definitely, that's a great point because there's a difference between interest and adoption. So a lot of people think the millennials have been the drivers of the increase in sustainable investing that we've seen. Millennials only represent about 10% of private wealth out there. So it's not exclusively the domain of the millennials. I think they're going to drive future growth. And then on the baby boomer and older generation side, I would say that there are a couple of things I could see that could drive increased interest. One is to Lily's point earlier about moving away from the earlier days of sustainable investing that was more about exclusion. So baby boomers invested through that, and maybe they are still hesitant because of some of the returns that they saw. So I think as that idea changes, we could see that unleash more demand. I would also say that there are themes that are sustainable that are unrelated to social consciousness and environment. There's a lot of aging-driven themes out there that are sustainable. So themes relating to healthcare, medical devices, cancer therapeutics. These are all things that we consider sustainable at UBS. And then finally, different asset classes. So yes, to your point, as baby boomers get older, maybe their time horizon is shorter, maybe their risk tolerance is going down, again, case by case. But green bonds, for example, that's an example of a sustainable product that you don't necessarily have to have, a high risk tolerance or a long time horizon to adopt.
So it is with regards to the asset classes. I mean, there's obviously, when we talk about ESG, a lot of it's in the context of equities, and we're seeing a little bit more fixed income come into the space. Lily, can you talk maybe a little bit more? I mean, beyond just the green bonds, we are starting to see pretty much across the board, whether it's corporate debt, sovereign debt, starting to move into this space as well.
I mean, with Nuveen as the lead sponsor, we really can't just talk about equities, right? They have one of the longest lasting fixed income strategies in the space. And I think holistically, we've always looked at a total portfolio and really seen how we can incorporate these attributes across all asset classes. So yes, we talk a lot about equities because that's where there's a lot of data. Frankly, there's been a lag of data on the fixed income side beyond corporates and beyond some of the thematic issuance like green and sustainability bonds. But fixed income has a long history in the space, and fixed income is quite interesting because you can actually track the dollar right to the use of proceeds. So if you're looking to create targeted impact in a public liquid portfolio, fixed income is a fantastic asset class to do so because ultimately, yes, you can target towards specific projects, but inside of a diversified portfolio that can ultimately help your client to meet their long-term financial objectives.
And what do you make of this idea? I mean, we've seen the ratings companies, S&P, making a couple big acquisitions, as did Moody's recently, I guess to provide a little bit more guidance, if you will, for at least for those who want it from them. What do you make of that? How does that sort of change the equation?
I think it's great. Look, we're starting to see some index creation right out of those big data houses. Certainly, we're really hopeful that there'll continue to be more fixed income ESG data, right, outside of the corporates across sovereigns and other entities. But we're interested in all these acquisitions. I mean, there's a ton of consolidation happening inside of the ESG data field, and I think that'll continue to drive innovation and continue to drive access for those of us who leverage this data on a daily basis to make investment decisions.
And if you're, let's say you are a fund manager and you're in this, I mean, we talked about kind of the impact on the portfolio, but I mean, how do you benchmark to this? I mean, can you just benchmark? You can't really benchmark yourself to the S&P 500 or a broader index.
Sure you can.
Okay, tell me why.
We strongly believe in utilizing traditional benchmarks, right? There was sort of a period of time where a lot of the investment strategies, maybe in, let's say, 2010, were being benchmarked to traditional benchmarks as well as a secondary benchmark. And ultimately, it became, talk about confusing, right, for clients. It became extremely confusing. And a lot of the secondary benchmarks weren't necessarily constructed in a way that was apples to apples to the strategies that were being compared. So we strongly recommend using traditional benchmarks. We think that's the approach that we're using to construct portfolios. So why not use that on the back end to measure performance?
And when you talk about, like, Laura, and I mean, the marketing of some of these products, particularly now that you're seeing a lot more ETF-type products, ETPs in this space, and how they're marketed isn't always clear. You know, I mean, if you go through, it's kind of hard to know which ones are invested in what sometimes. You just kind of know it's a socially responsible fund.
Right.
I mean, how does the marketing need to change, I guess, to make it a little bit more clear?
Right. So there is this notion out there of greenwashing. So calling a product an impact product just because it's somehow, applying a couple exclusions or looking at overall ESG scores. So there definitely is some of that out there. So that's why when I said earlier, it's important to really look under the hood. Good example I always like to throw out there, Tesla. Is that a sustainable company or not? Well, if you're looking at goods and services and focused on revenue, then yes, making electric vehicles, reducing emissions. But if you're more focused on the operation, so the ESG side of things, looking at things like, employee safety, governance, all of these other issues that we see in the headlines, then that changes the picture again. So you really need to understand what strategy a particular product is using. How is the data being used? What is the specific approach? And that will dictate whether it's appropriate for a specific client, and will also dictate what you can expect from the performance perspective.
Farnoosh?
It just sounds very conflicting sometimes, to your point. And so, I think we also really need to make companies more accountable to be transparent and to be the ones who are providing the necessary information, right? So I don't know, what is going on under the hood, to your point, at Tesla. Like, we do know, of course, a lot of things because they're publicly traded, but better to know everything before, there's a headline and things like that. So I think that, we need to also realize that another stakeholder in this is companies too, to realize that if they are doing the good work of, being, environmentally conscious, good to their employees, pay transparency, all of these things, that is part of what they're leading with, as well as profits.
Yeah. Do you find, though, that the companies that are responding to this, are they responding to it because of the investor pressure, or is it just general societal pressure, or do they themselves sort of have it in their mind that they can be better citizens?
I mean, my humble opinion is that the way you get buy-in from the senior-most levels is ultimately as a business decision, right? That ultimately the drivers of utilizing natural resources more efficiently are bottom-line drivers, right? And cost savings. That ultimately the drivers of reducing employee turnover and increasing talent retention, right, and diversity of your employees is, again, a business driver, in that that's actually going to drive innovation inside of your company and lead to, ideally, products and services, which can ultimately benefit top-line revenue. So I think it has to ultimately intersect with a business decision, and that's how you get buy-in and ultimately allocation of resources towards these ideals and objectives. And then to Farnoosh's point, right, it's about talking about it and talking about it in a highly transparent way, so that investors like us have access to information to help make better decisions.
Okay, so my colleague Lauren Keel, she's been sitting out here patiently. I believe she has some audience questions, right?
We do have some questions, and just a reminder, hi everyone, I'm Lauren Keel. Just a reminder that if you want to submit questions, please go to grif2019.app. They're going to come to me. I'm going to ask as many of them as I can of our panelists, but we're also going to be doing an Ask the Experts town hall at the end of the program today. So if we don't get to some of your questions now, we're going to try to get to as many of them as possible. And I know Laura's going to be one of the people joining us for that later. So let's take some questions. First one, how can millennial investors get access to the ESG information they need to make these decisions? Are financial advisors really in their budgets?
I'm happy to take that one. Traditional financial advisors are probably not in their budgets, but I think what we're seeing is changes in the financial services industry, where I often recommend people go to a site like XY Planning, where all the fee-based planners are willing to work with you sort of on either a retainer basis, an hourly basis. We'll just do a financial plan and charge for that, as opposed to a percentage of assets under management, which a lot of these clients don't really have a lot of. And so they are. This is a huge question that I get a lot from my audience. Is like, I want to get professional financial advice. I know that I probably don't qualify for like sort of the traditional path of going and working with an FA. Is there anyone else who can help me? And yes, there are a lot of people now who are realizing that there's an opportunity to work with millennials and younger investors who are still building wealth, who still are, should be getting a lot of guidance. And so I think educating them, they're at the front lines. All financial advisors, but in particular those that we're seeing working mostly with millennials and Gen Xers, and they are very, it's part of their brand, they will say very, very loudly that they work with this audience. And I think that, companies, 401k plan managers, HR, these are also people who are on the front lines, because as I said earlier, while a lot of young people aren't investing yet, the ones who are starting with their employers. I saw something that said, like, we trust our employers more than probably any other institution that we are a part of right now. So when they tell us, hey, this is a good idea, we will listen. And we may not take their advice, but we will listen. So you have a captive audience. And I think, just this online is the way to go, finding out where they are already existing and consuming. So I hate to say it, but places like social media and, news programs and all the different online places that they are at. I've actually had people on my podcast who run robo-advisors, or these automated platforms that are very specific to, ESG and, sort of like sustainable investments. And there are these kind of, very specific niche platforms out there that are trying to really get in front of millennials. So there's that too.
Let's take one more quickly. To the example of Tesla, do you think ESG has a blind spot by focusing only on operational aspects? But should it also be focusing on product? Should it be ESGP?
I think that's exactly right. It should be both. And that was kind of the point that I was trying to make earlier, that I wasn't really opining one way or the other on Tesla. You can consider it sustainable or you might not. It really just depends on the lens that you're looking at. So Sure, you can call it ESG and P. I think a lot of times when people use the term ESG, you can think about ESG as it pertains to both goods and services, so the products. I always say it's what the company does and how they do it. Two different lenses for ESG information. So that's absolutely correct. It's not just about the operational side, and I think that's what the question's alluding to in terms of saying ESG. It's also about understanding the goods and services. That is a very important element as well. Yeah.
All right, whoever asked that question, you should be on the panel next. Trademark that too. All right, I want to thank our three panelists today. You can give it up for them. Lily Trager, Farnoosh Torabi, and of course, Laura Kane. Thank you.
Thank you.